Welcome to the second online advanced accounting lecture. We have been discussing the topic of business combination, and we already talked about its benefits, its methods and types, and all its forms like merger and acquisition. In today's lecture, we are going to discuss the accounting for business combination. What do we mean by the accounting for business combination? We mean how we record the business combination process in the journal and how we measure the amount of investment paid in order to settle the deal with the combinee. We have two accounting methods for business combinations. We have the pooling of interest method and the purchase method. In the pooling of interest method, there is no amount paid or invested in order to acquire the combinee. Both firms agree that it is for their interest to become in one company and to get together in one company. So in pooling of interest, we don't have acquisition premium or an investment made by the combiner. But in the purchase method, there is an amount paid and invested in order to acquire the combinee. This amount is named cost of purchasing. Let's start by the purchase method, as it is the most famous method in business combination. First of all, we need to calculate and measure the cost of a combinee, or the cost of purchase, or the amount of investment paid by the combiner in order to combine with the combinee. This amount includes three items. The first item is the amount of consideration. This is the first part of the cost of combinee. The amount of consideration is the amount paid by the combiner or the acquirer to a combinee. It may be money paid or stocks or shares issued. Number two, the combiner's direct out-of-pocket costs. There are some costs associated with the combination and associated with the process. These costs are called out-of-pocket. The direct out-of-pocket is part of the cost of a combinee. And finally, the contingent consideration. These are amounts that will be paid later on as agreed between the combiner and the combinee. First, the amount of consideration. The amount of consideration is any value that the combiner is willing to pay for the combinee's shareholder for their share in the combinee's equity. Like what? Like cash paid, or the fair value of assets distributed, or the present value of debt securities, or maybe the current fair value of equity securities issued by the combiner. So the amount of consideration is the value of investment or the value sacrificed by the combiner in order to gain the combinee's shareholder share from the equity. Secondly, the direct out-of-pocket costs. Direct out-of-pocket costs includes some legal fees or accounting fees and also finder fees. These fees are essential for the combination process. What are finder fees? Finder fees are paid to investment banking or firms or any other organization that play a role in the combinee investigation and the business combination process. They do determine the price of the business combination also. These are the direct out-of-pocket costs. Finally, we have the contingent consideration. These are amount of cash or other assets or securities that the combiner promised to pay in the future to complete the business combination process with the company. Let's have an example to understand the purchase method. Assume that POP Corporation issued 100,000 shares of 10 par common stocks for the net assets of Sun Corporation. So this means that POP will be the combiner and Sun will be the combinee. POP Corporation wants to combine with Sun Corporation or wants to acquire Sun Corporation. So POP issued 100,000 shares of 10 par common stock in order to acquire or to buy the net assets of Sun Corporation in a business combination on July 1st, 2018. The market price of POP common stock on this date is $16, okay, per share. Additional direct cost of the business combination consists of, we have another additional costs other than the 100,000 shares issued. We have Security and Exchange Commission, SEC fees of $5,000, accountants fees in connection with the SEC registration statement of $10,000, costs of printing and issuing the common stocks certificates of $25,000, and finder's fees and consultant fees of $80,000. You are required to do what? First, we need to calculate the cost of combination. How much POP will pay or invest in order to combine with Sun according to the purchase method. Number B, prepare the journal entries for the combination. So, we have previously discussed that the cost of combination consists of three items. Number one, the amount of consideration. Number two, the direct out-of-pocket cost. Number three, the contingent consideration. Let's start by the amount of consideration. For this example, the amount of consideration equals 100,000 shares multiplied by 16, which equals to $1,600,000. So the amount of consideration here represents the shares, the amount of issued shares. In another example, it could be cash, or it could be cash and issued amount of shares. Number two, the direct out-of-pocket costs. Direct out-of-pocket costs here will be the finders and the consultant fees only, which is equal to 80,000. Okay, but what about the other costs? These are indirect costs. Here we need to calculate the direct out-of-pocket costs, which is the finders and the consultant fees only, which equals to 80%. This is part of the purchase cost. Okay, but registration and issuing costs like 5,000 and 10,000 and 20,000, 25,000, the total will be 40,000. These are called paid in capital in excess of par. So all direct out-of-pocket costs will be splitted into direct out-of-pocket costs and paid in capital in excess of par. The direct out-of-pocket cost is part and will be added to the amount of investment, which equal to 80,000 for finders and consultant fees. But other expenses paid or other costs paid, like registration and issuing costs, will be considered as a paid in capital in excess of par. Number three, we don't have contingent consideration. Therefore, the cost of purchase or the amount of investment paid by POP in order to combine with Sun equals to $1,600,000 in the form of issued shares plus $80,000 in the form of finders and consultants fees. For required B, we need to make journal entries. I'm gonna make two journal entries. One, to record the issuance of the 100,000 shares that POP issued for the shareholders of Sun, okay, and another journal entry to record the other additional direct costs and the direct out-of-pocket costs. Okay, let's start by the first entry. Investment in Sun will be in the debit side. This is the amount paid, the amount of consideration paid by POP to combine with Sun. It equals to 100,000 share multiplied by 10. This is the common stocks. The value of common stocks will be placed in the credit side, and 100,000 shares multiplied by 6, which is the difference between the par value and the market value, which is equal to 16. This is the paid in capital in excess of par. It will be placed in the credit side. So again, investment in Sun in the debit side. This is the 100,000 share multiplied by 16. In the credit side, we're gonna place the common stocks, which is equal to 100,000 share multiplied by the par value, and paid in excess of par in the credit side also 100,000 share multiplied by 6. What is the 6 here? 10 minus 16. Okay, this is to record the 100,000 shares at 10 par common stock with market price of 16 per share in a business combination. This is to record the business combination process. Then the second entry, we're going to record the out-of-pocket costs. We have the direct out-of-pocket cost will be charged to the investment in Sun. This is part of the investment, which is equal to 80, like we previously said. And we have paid in excess of par, which is equal to 40, and all these are paid in cash in the credit side for 120. What are these? These are the 80,000 finder and consultant fees and 40,000 for registration and issuing. These are the 40,000. Another example to illustrate the purchase method. On December 31, 2018, Mason Company, which is the combinee, was merged into Saxon Corporation, which is the combiner. This means that Saxon merged or acquired Mason. Saxon is the combiner and Mason is the combinee. In order to do that, Saxon issued 145,000 shares of its 10 par common stock, and the current fair value of these shares equals to $25. So Saxon issued 145,000 shares at 10 par common stock and a fair value $25 to the shareholders of Mason in order to complete the combination process, to Mason's stockholders for all Mason's common stock. So Mason's shareholders will give all their shares in Mason Company to Saxon. In addition, Saxon paid the following out-of-pocket costs. There were some out-of-pocket costs extra than the issued shares, which are: we have accounting fees for investigation of Mason Company, 14,000, for SEC registration statement for Saxon common stocks, 60, legal fees for the business combination, for SEC registration, finder fees, printers charges, SEC registration, and we have the total down there. Okay, so what are the direct out-of-pocket from these costs? The direct out-of-pocket are only in the accounting fees for investigation of Mason Company, 14,000, and for the business combination, legal fees for business combination, 10, and finder fees, 51. These three figures are the direct out-of-pocket costs. We also have Mason Company's balance sheet. This is the balance sheet for Mason. We have the book value and the fair value for the assets and the liabilities. You are required to prepare the journal entries needed to record the business combination, like the last example, between Saxon and Mason. First, let's calculate the purchase price, or the amount of consideration or the investment paid. It will be equal to the market value of stocks issued plus the direct out-of-pocket costs. The market value of stocks issued equal to 145,000 shares multiplied by the market value over the fair value of the share, which equal to 25, plus the 3 direct out-of-pocket costs that we picked a few minutes ago, 14,000 plus 10 plus 51 equals to 3,700,000. Number 2, let's calculate the fair value of the combinee's net asset, as there is a given balance sheet. I'm gonna subtract the total fair value of assets minus the total fair value of liabilities. The result will be 3,700,000, exactly like the purchase price. In this case, we say that there is no goodwill. When the purchase price value equals to the fair value of net assets, this is the case of no goodwill. Now we are ready to prepare the journal entries and record the combination process. First, we make a journal entry to record the combination between Saxon and Mason. We say that investment in Mason, 145,000 shares were issued at $25 fair value, and place the result here. In the credit side, we place the common stocks. It is the same amount of shares but multiplied by the par value. And the difference between the fair value and the par value will be called paid in capital in excess of par, will be considered as paid in capital in excess of par, and this is equal to 145,000 multiplied by 15. 15 is the result of 25 minus 10. Another journal entry is made to record the out-of-pocket costs. You're gonna split the out-of-pocket costs into 14 and 10 and 51. These will be charged to investment in Mason. This is part of the purchase amount. This is part of the investment, which is equal to 75,000. The rest of the costs are called paid in capital in excess of par, and both are paid in cash, so cash will be placed in the credit side. Finally, we make another journal entry to transfer the assets of Mason to Saxon and the liability due on Mason to Saxon. How? We're gonna collect the all assets, current assets, plant assets, other assets in fair value. These are the assets of Mason in fair value from the given balance sheet, and place it in the debit side. This is the journal of Saxon. When you place the assets of Mason in the journal of Saxon in the debit side, this means that you transfer the assets of Mason to Saxon after the combination is done. And there is a discount in long-term debt for 50,000. You can place it in the debit side. And all the current liability and long-term liabilities of Mason will be also placed in the credit side in the journal of Saxon. And you're gonna close the investment in Mason by 3,700,000. These are 75,000 plus 3,625,000. You need to close investment in Mason. It's placed here in the debit. Bring it in the credit to close it, as it is a temporary account. And by this, you have recorded the combination process between Saxon and Mason.